Matterport has been a hot topic for many traders lately. In this video, we're going to look at its price actions, the recent developments, the technicals, and my opinion on if you should be buying the stock. As the market is still very volatile at the moment, we should be mindful about which positions to pick, as well as their individual timing and exposure. Before the video begins, if you would like to see more stock analysis videos like this one, please remember to like, comment, and subscribe to my channel. Matterport has been having an amazing early 2022, seeing the stock price more than doubling over the course of a few months, which attracted a lot of new investors into the company. As we look at the products that it has, the needs that it actually fulfills, it's not difficult to understand why Matterport has an appeal for the tech and startup portfolios. It has a potential to disrupt the industry as it is, and this remains true no matter what, where the stock price is at. However, we must not forget that in the stock market, our goal is to ultimately realize a gain. And from the typical profile of the traders I've seen over the past few years, ultimately, it is not a question of whether you will be right, but when you will be proven right. Or to be more specific, when does the market agrees with your assertion? At the moment, it seems like Matterport will continue to be on a downward slope unless the market makes a U-turn on growth stocks or that Matterport has some major fundamental events. Now, let's also take a look at the technicals. The trading volume of Matterport has recently been around 3 million shares versus the average volume of 7 million shares. Over the previous 52-week period, the price fluctuated between $3.51 and $37.60. The trading volume is a metric telling you how many shares are being exchanging hands and whether there's a lot of activities and attention on the stock. It often gives you an initial idea about the popularity of a stock. When we use it to compare with the average volume, it can also tell us if the company is enjoying additional momentum to reverse its trend or to break through current resistance levels. Even when the current volume is lower than the average, it is an interesting indication because this could signify a trend reversal. The market cap of Matterport is currently around $1.1 billion versus an enterprise value of $2.1 billion. To put simply, the market cap is the fair market value of the company based on the current market sentiment, the company's reputation, and other macroeconomic factors, whereas the enterprise value is usually the cost the company has already paid for its assets after paying off the debts. It's worth mentioning that one of the most significant assets for a lot of growth companies are the intangibles, meaning they might not be items to be served right now, but they're secondary items to provide growth potentials for the future, such as pledges, schematics, intellectual properties, and brandings. For startups, most of their valuations are based on the intangibles, and they might be valued in more favorable market conditions. What this means in concrete terms is that there could be a big difference between the market cap and the enterprise value, giving the false impression that the market participants might be buying the company at a huge discount. It's only trading below the book value, but that doesn't mean that the company itself is necessarily undervalued. It's also possible that the company itself was overvalued in the first place and that it has deflated back to where it's supposed to be ever since. As we compare the current price to the historical price fluctuations, the stock is 9.1% higher than its 1-month low, 9.1% higher than the 3-month low, and 9.1% higher than the 52-week low. On the options market, which gives you a hint on the market sentiment about where the stock price could likely head next, the implied volatility is 96% versus a historical volatility of 90%. The put-call volume ratio is currently around 0.72. It is normal for most stocks to have a higher put option volume than what they deserve, as many institutional investors hedge their long positions by buying put options. The most recent volume of options traded has been 1.3 thousand contracts a day versus the 30-day average of 3.6 thousands. In terms of open interest, the most recent volume of open interest has been 205,000 contracts versus a 30-day average of 202,000 contracts. The option contract is a derivative from the underlying security, giving participants the possibility to have the right to either buy or sell the security at a predetermined strike price, buying the contract giving you the right and selling the contract giving you the premiums, with an obligation to execute the contract if the counterparty chooses to do so. It is often said that you can evaluate the likelihood of a scenario based on the opposite of what the current ratio is. If there are a lot of put options, there could be a possible uptrend on the move, or that the reversal might happen if there's a lot of call options. The reasoning behind this theory is because most traders try to catch up a gravy train once it's gone, and most option contracts would expire worthless as a result. In terms of the shareholder structure, institutional shareholders own 8% of the outstanding shares. The biggest shareholders include Vanguard, Fidelity, and iShares. It is relevant to understand the shareholder composition of a company, because this can help us to determine if you should hold the stock long-term or to view it as a trade opportunity. If the stock is mainly held by retail traders, this can be a sign that the stock lacks the depth to justify long-term trust from shareholders. Typically, the consensus is that there should be at least 25 to 30% of institutional participation for the stock to be perceived as a sound investment and not just a short-term trade. This is obviously subject to a lot of exceptions, since many great titles are also mostly held by retail, but that tends to be the exception and not the rule. Let's also take a look at the short interest present in the stock, which is the amount of positions aiming to profit if the share price falls lower. Sometimes, when there are significant short interest in the total volume, this could be a sign that there is an organized shorting operation going on, such as what happened with GameStop and AMC. The current short interest is 16% of the total float, and 59% of the transactions are coming out of the dark pools. Usually, if the short interest is above 15% of the total volume, with a significant portion of the short volume coming out of the dark pools, this could suggest that there are institutional positions taken to short the stock, and that there would be potentials for a short squeeze. My recommendation is to wait for a better timing to enter, even though the price may be fairly low compared to where it was in early 2022. I do believe that the price might continue to go lower in the short to medium term. I would recommend to commit between 0.5 and 1% of your portfolio, and to split your allocation in batches of 10 to 20% at a time. Now, given the current market environment, I believe that the equity market is in a vast phase of correction, especially when it comes to tech and growth type equities. The financial market has been living and breathing thanks to the continuous creation of new capital, with different waves of quantitative easings, which will have consequences on the price of assets as well as their yields. With the interest rates kept relatively low over the years and the increase of amount of capital in circulation, this will keep putting significant pressure on the profit that we can expect in investment products across the board. And this, by the way, is a reality that may shift in the years to come if the interest rate of core infrastructures within our globally financialized system increases. It's useful to remember that the market doesn't represent the real economy, and of course, the real economy doesn't always reflect in the stock performance, since the name of the game here is ultimately called supply and demand, which depends on a whole bunch of factors that go way beyond our own control. If we think about it, this is like saying, if your neighborhood house that is put up for sale is only allowing those who actually want to live inside to buy it, versus if you allow every single type of buyer with different intent or reasons to buy or to sell it. So obviously, there will be a significant difference in the price of this asset for those two scenarios. The market currently works more like the second option, and assuming that it would only reflect the fundamentals of the underlying economy would correspond to the first option. There are a few elements that are considered to be the reasons. The first one is the significant increase of amount of money printed by the central banks around the world, which is then distributed to the banks, with the expectation that they will be loaned to businesses. Normally, that's a good thing, but with a lack of opportunities in the real economy, the significant portion of that money actually went back to the financial system to buy up the price of existing assets. Now that the QEs have been wrapping up or ended around the world, I think that this drive behind asset price may no longer be as relevant as it is right now for the future. It is now compensated by the arrival of capital from one region to another, and from one sector to another even within the same jurisdiction. With the increase of tensions around the world, capital is always looking for a safe haven to park their money into, not just for a place to grow the nominal value, but with a currency that tends to keep its purchasing power as well. The third factor is the creation or the birth of artificial bubbles, either maintained by the market trends built up over the years or out of necessity. Capital needs to find a place to stay. Some good examples of this would include the EV sector in the 2020 and the oil and gas securities when there are tensions around the world. Either way, when it comes to the price trends of the market, the degree of uncertainty is a key drive behind the price fluctuations, and that is likely going to increase as we go on from there. When companies announce that they are going to enter or exit different markets, or that they will be trading on different platforms and exchanges, this can all have significant ramifications on the price of this asset. Some of the considerations to have when operating in this context include having a clear view of what is going on, especially regarding the cash flow and the capital flow, and avoid certain potential pitfalls. One of these is to be careful with short positions. Inherently, short positions are riskier than long positions as the downside of long positions is limited, whereas the short positions can lose you as much money as the stock price may reach, which is infinite. On top of that, we're now seeing a new phenomenon with short squeezes, involving a group of retail traders propping the stock price up, forcing short sellers to recover their positions. Sometimes the attempt will not succeed, but sometimes they end up in very spectacular success. Something else to consider is to treat tech stocks with care. To start, ask questions when the price of a security skyrockets without real fundamentals. It doesn't mean that you shouldn't be touching it with a 10-foot pole, but it does mean that there should be a difference between the decision of long-term holding and short-term trading. Either way, a rule of thumb is that each position should be structured in a way so that their individual performances will never affect the portfolio's stability. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.